Welcome to another episode of What's at Stake, a Penta podcast. I'm your host, Bryan DeAngelis, a partner here at Penta, and I'm joined by several of my colleagues today, including Stratton Kirton from our Washington office, and David Cook, a partner in Penta's UK office, as well as Cecilia Thorn, a managing director in our Brussels office. I want to welcome them all today. We're going to have a great conversation on ESG, particularly how ESG has long been a fundamental framework for evaluating companies' sustainability and ethical practices. But I think as we all have seen, and we've talked about before on the pod, in recent years, it has garnered much more increased attention. It's sparked some controversy and political debates, especially among investors, politicians, stakeholders. So today, we've brought together this group. These are our experts on ESG policies in both the US, UK, and the EU. And we're going to dive into the international landscape of ESG, particularly around reporting standards and regulations, providing everybody some valuable insights for those businesses that are operating across the different jurisdictions, and hopefully helping companies think about managing the potential political risks while also remaining, of course, in compliance with the regulatory standards. So Stratton, Cecilia, David, welcome. We've got a tall task in front of us, but thank you for joining the show.
Thank you.
Right, happy to be here.
Thank you.
Let's start maybe a little bit with the basics. So obviously we're sitting here in Washington, D.C. ESG has developed a little bit of a bad reputation in some political circles. We think of ESG in one way, but maybe Cecilia, I'll start with you. When you talk about and think about ESG and its significance in the business world, from an EU perspective, what does that look like?
I think if you compare it specifically to the US side, in the US it's much more politicized, while in Europe it's more driven from a legislative and regulatory directive. So we are really seeing a lot of forthcoming and current and forthcoming legislative developments, and some of them will also have extraterritorial implications. So there would be legislation around European sustainability standards that are soon forthcoming. We also have a so-called due diligence directive, which is about how companies' value chain, supply chain, and any human right. You have to have an overview of any human right or environmental issues globally. And we have also a new proposal on the table on ESG rating, which is much more about transparency on methodology around rating providers and also what companies need to provide. And all that is, part of the EU ESG agenda, and companies will need to not only understand what this means, but also implement these type of processes.
And when you and David are working with EU-based companies, how are they incorporating ESG factors into their decision-making process? We've seen it in the US, and we'll talk more about this. It was a very focal point for a lot of their decision-making for a number of years. I think, and maybe Stratton will agree or disagree, we're seeing a little bit of a trend where they're still doing some of the work, but maybe talking about it a little less here in the US, given some of the politics. But where do you all see EU, UK companies? What impact is ESG having on their kind of interactions with their investment stakeholders, with financial institutions, et cetera?
So just to build on Cecilia's answer, I mean, in the UK and in the EU, there is almost no opposition philosophically to ESG, the ESG agenda and the ESG regulatory program. Of course, that changes when you actually are legally required to do things. And in the UK, they are slower on the regulatory agenda than the EU for a number of reasons. That is also, in theory, allowing them to learn the lessons of the implementation of the EU agenda. And so they're taking it a little bit differently. There's also been, as everyone has seen, some sort of political turbulence in the UK, which has slowed down the legislative agenda as well. But I think what firms are seeing is a divergence in approaches. You've got the EU miles out ahead. You've got the UK following behind willingly, but slightly differently. And then you have the sort of differences of opinion that are taking place in the US. And actually, I was talking to someone in the City of London a few weeks ago who said that they feel really caught between a rock and a hard place, and that they can't do enough in Europe, but they're doing too much in some parts of the US. And this is really frustrating that they're actually just falling down between two stools.
Yeah. I want to get into the politics and the perceptions of this, but Stratton, maybe to start us, we are maybe miles behind the EU, but we're doing some things, and the SEC has been doing some work. You want to give us a lay of the land here in the US?
Yeah, absolutely. And that's exactly the point I was going to make, is nobody should walk away with the perception that companies aren't doing a lot on ESG. I think most companies operating in the US, particularly Fortune 500, would say they're doing a lot. That these are prominent issues, they're table stakes for them in many cases. But to David and Cecilia's point, I think it's more market-driven competition between companies, where they have pressure from consumers, from investors, and then, yes, as many of the critics on the conservative right would say, also activists who want companies to do more around diversity, inclusion, environmental issues, governance issues. And so all of those factors coming together is they are looking at their other peers and saying, okay, if I'm a large bank, and my leadership isn't super diverse, but my competition's leadership is super diverse. One, the market research shows that's a commercial benefit to them, but also, that's a reputational risk that they have to deal with. So they're focused on it. Now, you mentioned, I think the government, and maybe this is to David's point too, is the government in many ways is sort of playing catch up to where companies are now in the US, where the SEC at least focused on the environmental part of ESG, is now working towards disclosure rules. Most large companies, if not all large companies, already have scope 1 and 2 to some extent, but the SEC is likely to formalize that later this year. I've heard October. Of course, we also heard it was going to happen last year.
I was going to say,
and then
waiting on this one for a while.
And then the big question is will they dive into scope 3 throughout the entire supply chain? I feel like the tea leaves right now say probably not, but it's really more codifying disclosure rules so that everybody's going to be reporting these emission standards in the same way versus forcing companies, or at least for large companies, to do things in a new way.
You said you started to talk about stakeholders a minute ago, and it reminded me too, employees are driving this a lot. I've heard from a number of CEOs that as they're interviewing folks, the first thing they want to see is not the compensation package, it's the ESG report, and that like competition for talent, and are you doing whatever, the right things, or, have a strong record on ESG is driving that fourth bucket of stakeholders as well.
Oh, absolutely. And I think there's some variance probably in industries, not to stereotype, but, in the tech industry, the employee stakeholder is a huge stakeholder that, has to be taken into consideration. But you also see it very prevalent in financial services. And I would also argue actually increasingly in traditionally small C conservative industries like the energy industry as well.
Yep, I think that's right. You're even seeing it a little bit more in consumer goods. And
we're definitely getting that here because, if you're looking to attract the brightest and the best, particularly out of university, who have quite a big choice, then your sustainability story and reputation is vitally important.
And I think to add to this exactly what new requirements in the EU that is about to kick in under the CSRD means that companies, before they could do a standalone sustainability report, and then of course they separated that from the financial report, but that's going to be integrated. So you will have to actually provide sustainability ESG data as well as financial data in the management report. And that of course has implications for boards and companies, because that's kind of part of your listing requirements. And there's also going to be a mandatory audit or assurance process. So, all the information that previously you would have integrated in a sustainability report will now really, you have to be very, very careful about what you say.
Cecilia, maybe that's a good segue to my next question. Tell us more about kind of the current landscape of reporting standards, especially in the EU, but I'm interested in how that compares to the UK. We heard a little bit from Stratton that the SEC will get there eventually, but what do you guys, where do things stand now overseas?
Well, it's actually at a very interesting stage. So we had in the EU, you have an implementation of a directive, and within that directive, it said that the European Commission needs to put forward detailed ESG standards. So it's going to be on all ESG. And that will become EU law. It's called secondary legislation. So that means that these detailed requirements, all companies that are captured by this directive will simply have to follow it.
Right.
And it's in a very late stage process. We have just actually today, a stakeholder consultation with businesses have ended. And we are expecting probably next week, but definitely in July, that the Commission will come out with the version they want companies to use. And there is a lot of controversy around this at the moment, because we had some of them, the proposed mandatory have become more voluntary. There is subject to materiality assessment. And very interesting here, we see the investor community, and they've just wrote a letter to the EU, to the commissioners, saying that they want very stringent mandatory standards, that in the investment community needs this. So they want companies to report on that. And they don't want voluntary or too much materiality assessment for companies to decide, because they themselves are subject to these rules and they need to understand what they invest in. So that's an interesting pressure, that you have the regulatory pressure from the institutions, but then also you have investor-led pressure to say, well, we actually need corporates to do this, and we want more details.
Yeah. And I'm pretty sure I know the answer here, but it may be helpful. This is all investors, U.S. investors, U.S. companies. This is not just a couple of folks leading this effort from the EU side. Likewise, the reporting standard is anyone doing business in the EU, I assume.
Yeah, this is the thing. If you're going to do business in the EU, you will simply have to follow some of these rules that will soon kick in. But of course, what we are talking about is to what an extent this will have implications for other jurisdictions, such as the UK and the US. But I think when the material is out and when companies will have to start to do this exercise, boards will need to start to look at this from a strategic perspective and say, well, this is not just reporting and reporting as such. It's actually about telling the story of our company. Like we talked about before, attracting talent. It's about, your own stakeholders and your wider stakeholder community. This is basically your reputation at stake.
Right.
And you can profile yourself. So it needs to be thought about not just as a European process, but really as a global voice. Who are you and what is the story you want to tell? And that story will also be told in the management report. So it's very, very, you have to be very, very careful about this.
Yeah.
Yeah. If you think about where the EU has been, the EU is sort of divided into 5-year blocks between European elections and commissions. And this current commission, which will come to an end next year, its really sort of strategy has been a sort of tagline of green finance and finance green. So make finance much more greener and then make it finance the greening of the overall economy. But you've got to remember that ultimately the European Commission is a regulatory machine.
Right.
And so its main power is to create regulation. And the political dynamic within the EU is around harmonization within the single market. So what you've had is a series of very complicated, quite detailed rules that must be followed, and they try to make those to be followed in all the 27 member states of the EU in the same way. Now that causes challenge for those
No
outside
small
the
task,
EU.
I was going to say, yes.
Yeah. So firstly, they're all very complicated, and it's actually, and some of the rules have come the wrong way round, which has not been very helpful. For example, the requirement to report has come before the actual details of what you need to report are ready. But in the UK, the UK is also ambitious in this space, and the government, looking to benefit from its own regulatory freedoms away from Brussels, has gone for, has tried to build up the UK's own credentials, but it's much more comfortable with a more flexible approach. And actually, it started with rules that are much more around comply or explain. I.e., you don't have to do it, but you need to explain if you don't do it. And that is easier to implement, but in a way, it sort of causes a headache. And if you've got a compliance department and you are having to meet rules, you don't really want to have a very different approach in all of the jurisdictions. And if you're dealing with Europe, you need to be following EU rules. And actually, it's probably just easier to roll out whatever's the most onerous set of rules to the whole global approach. And that would probably include Asia and the US as well, to some extent.
Yeah, this is going to be my next question. We talked a little bit before we started recording, but there's a strong emphasis on human rights and supply chain transparency. And if you're reporting that in Brussels, people in London and people in Washington and people all over the world are going to get the same information. Investors are going to get that information. Policymakers and regulators are going to get it. So the idea that, you might have an easier road in the UK or the US, you still need to have a very strong story to tell, because that Brussels story will be what people see.
Yeah, I mean, that's an excellent point, because if you're, firstly, you need to watch what's going on in the EU, because chances are you're going to have to do it at some point. Mm-hmm. And secondly, all that information is going to get out, and is that going to present the reputation in a fair and sort of proportionate and just way?
Exactly. And I think the important point here is to say new rules that are likely to be adopted at the end of this year will actually have global implications for companies, because there will be rules around due diligence and supply chain reporting on both human rights and environmental issues. And these new rules will actually allow NGOs and trade unions and other actors to sue companies if they feel they are in breach, and they will sue them in EU member states. So that also have legal implications. So companies, whether or not they are, they have global operations, but they have a presence in Europe and they're captured by this, will mean they have to be very careful about what they do, and also look at the liability risks.
Well, I think this gets to a point, sort of a macro point of re-anchoring ourselves of like, what is the actual intention of ESG? Because here in the US, highly politicized. In Europe, maybe over technical conversation. The goal is to explore fiduciary risks that aren't traditionally taken into account, and then reputational risks that maybe for a company provide, if you don't look into them, short-term benefits, but long-term risks, and to actually make a stronger company, in a financial sense as well as a reputational sense. And so I think, re-anchoring ourselves when we're thinking about what are we reporting on ESG? How are we talking about it? The goal is to address exactly what you said, that we can't silo reputation markets. It's that thinking that consumers in one part of the world aren't going to care, if we have human rights abuses in our retail supply chain versus consumers in another part of the world.
Yeah. I have this conversation with clients a lot, but we always forget about the G. And it's governance, we have a short memory, no one wants another Enron. No one wants another Arthur Andersen. There's a reason we have these, and it's not politics. Yeah. But I do want to talk politics, but let's take a really quick break. We can come back. We'll jump into a little bit of the political landscape in addition to the regulatory landscape we just discussed, and how companies should start thinking about all these developments in their day-to-day operations. We'll be right back on What's at Stake.
Penta is the world's first comprehensive stakeholder solutions firm. We are a one-stop shop for the intelligence and strategy leaders need to assess a company's reputation and make decisions that improve their positioning. As executives in the C-suite must account for a growing set of engaged stakeholders, all with distinct, fast-changing demands, Penta provides real-time intelligence and strategy solutions. We work with clients solving complex global challenges across a variety of industries. Our clients span technology, financial services, energy, healthcare, and more. To learn more about how Penta can support your company, check out our website at pentagroup.co, our Twitter at PentaGRP, or find us on LinkedIn at Penta Group.
Welcome back to What's at Stake. We're talking ESG with a few of our colleagues here in Washington, as well as Brussels and London. And I want to dive right into the fun stuff for me, the politics of this. We've been focused on it a lot in the U.S., but Stratton, we've seen a pretty aggressive conservative backlash against ESG initiatives.
July is ESG month, Bryan.
It sure is. So on that point, tell us what's happening, some of the stuff we're seeing in this world.
Yeah, absolutely. I feel like this really popped up for me in a big way the first time about a year ago when Vice President Mike Pence had an op-ed in the Wall Street Journal, which was a huge signal that anybody who was probably going to run for president was going to make this part of their platform. And we've seen it take a legislative route now, kicking off at the beginning of this year in Congress with the House Financial Services Committee, where there's an anti-ESG task force who have declared that July is ESG month, or maybe more accurately anti-ESG month. Yeah. And we don't know exactly what they're going to look into yet, but they've led some pretty big breadcrumbs. SEC is going to be a big target, as we discussed before. Asset managers are going to be a big target. There's a hypothesis on their part that asset managers aren't actually representing the view of shareholders.
Yes, and we saw this start in the States and now bubble up to federal government. Yes.
And then generally a focus on trying to pass laws, even if pass bills in the House, even if they know they're not going to pass the Senate, that re-anchor around the fiduciary duty. That most prominent over every other issue is financial performance and financial returns, and that anything else comes secondary after that. I think there's a view that, as I mentioned with the asset managers, that a small minority of activists are driving these ESG issues. And, we can debate how accurate or how wrong that is, but there's definitely a perception, at least with House Republicans, that this is not a reflection of what customers want, of what employees want, of what consumers want, in contrast to what we were talking about earlier.
And David mentioned this earlier, but I feel like it's very true in the U.S. too. Companies are stuck in a rock and a hard place here. I feel like a few years ago, it was whatever term you want to use, but it was popular to go out there and be aggressive on your ESG announcements. And we saw a lot of CEOs leading on that. My sense is they're still doing a lot of that work. They're just, they know the other side is now in charge, so they're a lot more quiet about it. But what are you seeing?
No, I think that's right. I mean, I think a lot of companies are still trying to struggle through this, but we've certainly seen some of the early adopters on ESG have literally come out in public and just said, we're just not going to say ESG anymore. We're going to talk about the results rather than the framework. And in terms of the rock and the hard place, I think for large companies, for global companies, certainly it's a challenge navigating, the EU versus UK versus US. But even within the states, as this has sort of metastasized at the state level, it's getting very challenging. It's like you have companies cutting banks out of bond markets because they don't agree with them on their, lending portfolio as it relates to guns or climate or LGBTQ issues. So the market has a real risk of getting fragmented.
And David, Cecilia, forgive me, but I do have to ask, so the EU has also become a bit of a dirty word here in this political debate, where we were talking about this before, but ESG is now becoming a dirty word in parts of our politics, and they're connecting that to companies pushing this and then the EU making us do all this stuff. But we know that's not true. But what are you seeing over there? I don't get the sense that there's the same political discussion, but are you finding it harder as you work with even American companies on some of these issues?
I think it's interesting to have the discussion about fiduciary duties, because it could be viewed in from different perspectives. And I know in the UK, for instance, I used to work for the FRC UK standard setter and regulator in this space. And I mean, fiduciary duty, we would look at it in a broader perspective. So of course it has financial implications, but you would say that to really take your fiduciary duty seriously, you need to have a lens, and you have to look at climate, you have to look at ESG issues, because it's part of of assessing a company and the investment criteria. So it would be not just a strict financial lens, but you would also look at these ESG issues, climate issues as part of that parcel to be responsible. So I think that's also a different angle than the US angle. But I mean, we've seen lately that some of the I think Yellen was talking about extraterritorial implication of EU legislation, and they are starting to talk about such European reporting standards, the due diligence directive. I think people are waking up to this, that we're going to have EU rules with international implications, and what would that mean for, let's say, American companies? That, I mean, if you're a large private company in the US, you don't have to do any type of reporting around sustainability, but all of a sudden you might be captured in the EU, and that has, of course, different implication, because it would mean that the EU is pushing for a framework that does not exist in the US. So it's very important, this dynamic, and very interesting.
I mean, it's interesting to listen to this conversation. And of course, there are significant burdens being put on firms. And that in itself should worry, and firms should be following what's happening and engaging where it's appropriate. But ultimately, no one is making, this debate in large part comes from greenwashing. And that is people saying that they were providing sustainable investments. And the reason they were doing that, or the reason that, that was such an issue, is the demand for sustainable investments. That's coming from customers, that's coming from people, that's a business opportunity. And to ensure that people are genuinely they know they're putting their investments into truly sustainable investments. That's where the frameworks have come from. But no one is saying it is now illegal to invest in things that don't qualify as sustainable. That's why it's an interesting debate, because
it is.
We haven't got to the point where we're actually directing the investment. We're just the regulators are trying to make it easier. And that's where the UK comes in. The UK thinks if we can get the framework correct, then all of this demand for sustainable investment will come through London. And that, in theory, is a brilliant opportunity for the British
It certainly
economy.
is. I mean, this is part of the debate in the US, but it turns into, and I've worked with some clients on this, capitalism 101. Like, there is a demand for these products, and these companies are meeting that demand. There was a time when we used to celebrate that.
Well, I mean, it's fascinating, the framework that they see it as a competitive advantage, where the conversation here is you're holding companies back.
You have to stop that. Yeah. So advice or how we're working with clients as they think about this. David, you mentioned, clients have to be monitoring it, have to be engaged. I'm curious, Cecilia, David, if you have any good case studies or best practices that sort of highlight the impact these developments are having on companies' ESG initiatives, how those companies are engaging and thinking about their stakeholders on this front. Anything ideally successful, but we could take unsuccessful too.
Yeah, I mean, I just before that, quickly, I would just mention that, we had new standards coming out of the International Sustainability Standards Board. They released 2 new standards at the end of June. And that is, trying to kind of build an international framework where, I know with the EU standards, they will fit. And, in the US, they were very clear that this is not a value-driven, it's not about values, it's about value. So, it's also to kind of make sure that the US audience will not feel that these standards are a part of kind of a sustainability framework that is driven by doing good, or it should be more about, the opportunity for companies. So we'll have to see exactly where this goes. But I know for the UK, for instance, said that they will implement this. And I know that in the EU, they work very closely to ensure that these standards fit together. But that was just a side way.
Yeah, no.
But in terms of working with clients, we already see that there are companies here that we work with that they are following this closely, and they want to understand better what all this means. It's very complex as well. So they also need kind of I wouldn't say an audit, but they need us to help advise and guide them whether or not these standards apply to them, to what an extent, what do they need to do to have a better understanding. But there is also the piece about, if you have to report on your entire value chain, or you have to have an overview of your entire value chain, that means your management processes and your compliance processes must change fundamentally. The board will really need to sit down and think about how all these fits together, because there are big decisions to take. It's no longer just, the sustainability information is there and it's good to have. It's really about adding value and also minimizing risk. So this is also for the risk committee needs to be very much involved. So we have helped companies. We have hosted workshop for boards and senior leadership in some companies, actually outlining the legislation in this space and helping them to understand what this means and the questions they need to ask themselves. And that it is also, to what an extent, if we do this, we have to, at the end of the day, make sure that we can access capital and that we can have a good rating. So there are bigger issues to really reflect upon. And that's why I think it's important that boards and senior leadership in companies are involved on these issues.
I think from a firm's point of view, in my experience, there are kind of three things. Firstly is the proportionality of the regulation. Like what kind of burden will it put on? Secondly, it's will the regulation create risks to the business and what they do, product lines particularly. And the third element is, will it create opportunities? Do you have a data set that will become more valuable, for example, if everybody needs to is required to use something similar to meet their regulation? But although I don't want to go into examples, we've seen that actually this is very difficult for the policymakers. They need the information. They need the information presented to them in a way that they can use it as well. They're not out there to make things difficult, but they are under pressure themselves to produce regulations that are workable and effective in a certain timescale. And they are hungry for support in that, because they're not market experts, and if you can identify where there are, say, you won't be able to provide your product labeled as a sustainable product if those regulations come in as they are, then go and see the policymakers and talk to them about the impact of what they're doing and why actually that wouldn't actually advance the political objectives of either the EU or the UK. And that, these people are listening. They really are.
I couldn't agree more. You stole the answer to what was going to be my last question, but I think I think you're absolutely right. And we're going to see both the regulatory environment and the political environment probably heat up and continue to evolve over the next couple of years. And I think the advice that David just laid out is how companies need to be thinking about this, especially as we head into elections. But with David already answering it, I'll throw it out to Stratton or Cecilia for any final thoughts.
I think you're right. I think David and Cecilia did a great job. I think there are a couple elements, as David was talking about, education with people is one, communicating what is the materiality of why you're doing these things back to your business. And that to me is what's hard to get over with the ESG conversation in the US. If you're an insurance company, how can you not look at climate and environmental impacts? So it's right. So I think there's that element. So you have to communicate why it's good for the company as well as just why you're doing good. And then I think the other thing that is maybe missing in the debate is for many companies, if you are a supplier for a large retailer, for a large manufacturer, like oftentimes you're just meeting the standards that they set. It's really no different, if they had asked for a different product specification too. So, there are really fundamental market forces that are driving this in many ways in the US. So
meeting demand.
Right.
Yeah.
So there's definitely room for debate on making sure that like fiduciary responsibility is part of this conversation. But there are like fundamental elements of like looking at, as Cecilia said, looking at risk in your business, as David said, on communicating like why this is material to your business and like why people you are selling to are demanding it, that I think means this can't be an issue that gets swept away, regardless in DC at least, who's in power, Republican or Democrat.
Yeah, well said. Well, let's leave it there. Obviously, a complicated subject, one I'm sure we'll return to many times in the future. But Cecilia, David, Stratton, thank you so much for joining us on this week's show. We really appreciate the insights from Brussels and London and, of course, DC. To all our listeners, hope you enjoyed this episode. Remember to like and subscribe wherever you listen to your podcasts. You can follow us on Twitter @PentaGRP. I'm your host, Bryan DeAngelis. As always, thanks for listening, and we'll be back next week with another episode of What's at Stake.